Money, the mirror of human nature. Some have it, some don't. Some have mastered it, and most are endlessly chasing it. You might think of money as numbers, spreadsheets, equations to be solved. But the truth? The biggest financial decisions are rarely made on calculators. They're made around dinner tables, with ego, pride, fear, and the emotional baggage of our past. The real nature of money lies in the tension between cold arithmetic and human behavior. Because when it comes to money, we are deeply emotional creatures, not rational ones. And ultimately, financial success is less about how much you know and more about how you behave. This video was inspired by Morgan Housel's brilliant book, The Psychology of Money. Let's dive deep into the human side of wealth, success, and decision-making. Our financial DNA, why we think differently about money. Each of us carries a unique financial blueprint shaped by our upbringing, environment, and generation. Our parents' income, the economy we were born into, the opportunities we had, or didn't, all sculpt our relationship with money. Take the stock market and inflation, for example. Those born in the 1970s watched the S&P 500 explode nearly tenfold through their teens and 20s. Naturally, they grew up trusting the market. Those born in the 1950s saw stagnation instead, shaping a skeptical view of investing. The 1960s generation lived through massive inflation, developing a lifelong fear of rising prices, while those born around 1990 experienced relatively stable inflation, making them less sensitive to its dangers. We interpret money through the lens of our experiences. Our choices, even the bad ones, make perfect sense to us in the context of our personal story. As Housel says, people do crazy things with money, but no one is crazy. We just see the world differently, and that's the beauty and the danger of human finance. The compound kings. Buffett's real secret. Warren Buffett is often called the greatest investor of all time. But here's the staggering truth. Over $81 billion of Buffett's $84 billion fortune came after his 65th birthday. Why? Time. He started investing at age 10. Compounding did the rest. If you invest $1,000 at an 8% return, you'll earn $80 the first year. Reinvest it, and next year you'll earn interest not just on your principal, but on your interest too. That's the magic of compound interest, the most powerful force in wealth creation. Now imagine if Buffett started investing at 30 instead of 10. Even earning the same returns, his wealth today would be just $11.9 million, not billion. That's the power of starting early and staying consistent. Jim Simons, the hedge fund legend, earned 66% annual returns, triple Buffett. Yet his net worth is a fraction of Buffett's because he started late. In finance, time in the market beats timing the market. Always. Pessimism versus money. Why bad news sells. Optimism says, things will work out in the long run. Pessimism screams, everything is collapsing. Guess which one grabs headlines? We're wired to pay attention to bad news, especially about money. A market crash gets instant coverage, but a decade of gradual growth hardly noticed. Every year, quiet progress on from medicine to technology saves millions of lives and creates billions in wealth. But slow success never trends. Instant disasters do. Yet history shows that the long-term trend of humanity is upward. So when you hear about financial crises or stock market crashes, remember, over time, progress wins. Real financial intelligence isn't blind optimism, it's rational optimism. Luck, risk, and the hidden variables of success. In 1968, out of 300 million high schoolers in the world, only 300 studied at Lakeside School in Seattle, the only school with access to a computer at the time. One of those students was Bill Gates. From 300 million to 300, a 1 in a million advantage. Without Lakeside, there might never have been Microsoft. But there was also Kent Evans, Gates's close friend, equally brilliant, equally driven, who tragically died in a mountaineering accident before graduation. Luck and risk, two invisible forces, shaped their destinies. Success isn't just about effort or genius. It's about being in the right place at the right time and staying there long enough. As Housel puts it, luck and risk are siblings. Both are beyond your control. Recognize them. Respect them. The true dividend. Freedom over fortune. People chase money to feel happy, but happiness doesn't come from wealth. It comes from control. The real measure of financial success is the ability to do what you want, when you want, with whom you want. Freedom, not luxury, is the highest dividend money pays. Most people trade time for money, then spend money trying to buy back time. That's a broken loop. If you don't have control over your time, your wealth owns you, not the other way around. Remember, time wealth beats net worth. The power of tail. Events, big wins, many losses. Heinz Berggruen, a refugee who became an art dealer, made millions selling works by Picasso and Matisse. But here's the twist. Most of the art he bought was worthless. A handful of masterpieces made him rich. This is the long-tail principle, where a small number of outcomes drive almost all the results. The same is true for venture capital, business, and investing. Most startups fail, but a few unicorns return hundreds of times the original investment. Amazon, for example, owes most of its success to just two tail events, Prime and AWS. Everything else, minor failures. Even Warren Buffett made most of his money from just 10 stocks out of 100. In finance and in life, you only need to be right a few times. True wealth versus being rich. Being rich is about your income. Being wealthy is about your assets you haven't spent yet. You can't see true wealth. It's hidden in restraint, savings, and long-term thinking. That guy driving a Lamborghini might be rich, but the person quietly investing every month, that's wealth. We're conditioned to equate spending with success, but the real flex is not spending. Wealth is built in silence through discipline, patience, and delayed gratification. The real price of success. Investing is like climbing a mountain. You know it will be tough, unpredictable, even painful, but the view is worth it. Yet, in the stock market, people try to skip the climb. They chase shortcuts, timing strategies, free money. But every reward has a price. Volatility, fear, uncertainty. If you see those as penalties, you'll quit. If you see them as the entry fee to wealth, you'll win. Great investors accept the emotional roller coaster as part of the deal. That's the true price of financial freedom. The hedonic treadmill. Knowing when. Enough is enough. The moment we achieve one goal, we move the goalpost. A new car becomes an old car. A bigger house becomes not big enough. This is the hedonic treadmill. Endless chasing with no finish line. Even billionaires like Bernie Madoff and Raj Gupta fell victim to it, risking everything for more when they already had enough. Wealth without contentment is just anxiety in disguise. The key to lasting happiness isn't having everything, it's knowing when to stop. Enough is the real luxury. The psychology of money is the psychology of human nature. It's not about intelligence, but self-awareness. Not about knowledge, but behavior. Master yourself, and money will follow.